Welcome to today's insightful video on 5 golden rules for investing in recession, as highlighted by Warren Buffett. Buffett's approach especially shines during recessions, where he sees not a crisis but opportunities. As Warren Buffett advises, look at market fluctuations as your friend rather than your enemy. Profit from folly rather than participate in it. This underscores the value of investing during recessions. The first rule from Warren Buffett is to focus on building liquidity. Now, you might be wondering, what does that mean? Well, in the simplest terms, liquidity refers to the readily available funds you have at your disposal. These funds can be quickly converted into cash without impacting the market price. Why is this important, particularly during a recession? Well, a recession presents unique opportunities. As businesses struggle, their market value may drop, leading to undervalued prices. This is where liquidity becomes your secret weapon. With sufficient liquidity, you can swoop in and purchase these businesses at a discounted price, much like Buffett himself did with his successful investment in Coca-Cola in late 1980s. But the key here is not to be hasty. As Buffett wisely advises, be fearful when others are greedy and greedy when others are fearful. However, you should not rush into investments during a recession, but rather, wait for the right opportunity to strike. And finally, remember that building liquidity requires a disciplined approach to saving and investing. So, start today, because the more liquidity you build, the more opportunities you can seize during a recession. Keep in mind, liquidity is your best friend during a recession. The second rule from Warren Buffett is to invest in proven companies with strong fundamentals. A key part of this strategy is understanding that a company's value isn't determined by the whims of the market, but by its real-world performance and stability. Take, for instance, Buffett's investment in Coca-Cola. He didn't choose this company because it was trendy or because of some speculative potential. He chose it because of its solid track record, its robust financial health, and its ability to consistently generate profits. History of strong earnings, a diverse product portfolio, and a powerful brand presence across the globe. These are the kind of fundamentals that make a company a good investment. They're indicators of a business that can weather economic storms and still come out strong on the other side. Remember, the aim here isn't to make a quick buck. It's about investing in a company that's built to last, one that will continue to perform well and provide steady returns regardless of climate. It's about being a value investor, just like Buffett himself. Value investing is all about buying shares in companies that are undervalued by the market but have strong fundamentals and the potential for long-term growth. Investing in strong companies ensures stability even in tough economic times. The third rule from Warren Buffett is to put money in productive assets. This rule is all about investing in things that have the potential to generate revenue or appreciate in value over time. Think of it as sowing seeds in fertile ground. You're not just burying your money in the soil, you're planting it in a place where it has the chance to grow. Productive assets could be anything from stocks in growing companies, real estate, or even your own education. These are all things that, given time and care, can produce a return on your investment. It's not about quick wins or easy money. It's about understanding the potential of an asset and nurturing it to fruition. Warren Buffett himself has a diverse portfolio, from owning shares in successful companies to investing in real estate. His success is living proof of this rule in action. However, it's not just about buying an asset and waiting for it to appreciate. It's also about being proactive in managing these assets. This might mean keeping up with market trends, regularly reviewing your investment portfolio, or continuing to upskill and educate yourself. So when faced with a recession, don't just sit on your money. Invest it in productive assets. Productive assets can provide a steady flow of income, even during a recession. The fourth rule from Warren Buffett is to maintain a business-as-usual outlook. Recessionary periods can stir up emotions, create panic, and lead to hasty decisions. But the Oracle of Omaha advises otherwise. He encourages us to keep our heads cool and continue to invest wisely, despite the economic downturn. This doesn't mean ignoring the realities of a recession. Instead, it's about making informed decisions, grounded in solid research and long-term thinking, not knee-jerk reactions to short-term market trends. Never forget, even during a recession, businesses are still operating, goods are still being produced, and services are still being delivered. In fact, some businesses thrive in such conditions. It's these opportunities that a smart investor seeks out. So when the market is in a frenzy, it's more important than ever to maintain a steady hand on the tiller. Warren Buffett himself has often made his best investments when others were too fearful to act. So let's take a leaf out of his book. Keep calm, carry on, and continue investing wisely. A calm and collected approach can make all the difference in your investment strategy. The final rule from Warren Buffett is to invest for the long term. This concept is simple, yet profound. When you're investing, you're not buying for today or tomorrow. You're buying for the future, for years, even decades down the line. You're purchasing a piece of a business, not a lottery ticket. It's all too easy to get caught up in the frenzy of market highs and lows, but the truth is, short-term market fluctuations are just noise. They're distractions that can lead you away from your long-term goals. Successful investing isn't about timing the market. It's about time in the market. Patience is a virtue in the world of investing. It's about waiting for the right opportunity to buy and then having the fortitude to hold on to your investments even when the market is down. Remember, downturns are temporary, but the upward trend of the market is permanent. In Buffett's words, bad news is an investor's best friend. It lets you buy a slice of America's future at a marked-down price. These are the 5 golden rules for investing in recession as per Warren Buffett. In the roller coaster ride that is the investment market, these rules are your safety harness. Let's quickly recap. 1. Focus on building liquidity. It's your safety net during hard times. 2. Invest in proven companies with strong fundamentals. They're like sturdy ships that weather turbulent seas. 3. Put money in productive assets. They're your cash cows, steadily churning out returns. 4. Maintain a business-as-usual outlook. Remember, panic is an investor's worst enemy. 5. Invest for the long term. It's a marathon, not a sprint. Keep in mind, a recession is not a time to panic, but an opportunity. So, keep a level head, follow these rules, and you'll be well on your way to building a successful portfolio, even during a recession. Don't forget to comment, like, and subscribe. Share your thoughts on Buffett's rules. Until next time with another Investor Viewpoint, keep investing wisely.